We have this perception, and I believe it's an incorrect perception, that it's a bounded economy, like sort of like a swing that's on a chain and it can't ever go below a certain level. And in fact, the economies are more like natural systems. And in natural systems, things are unbounded. Things can go to extremes. So one needs to bring the perspective that, if things go very badly for a country or for an economy, it's possible that this bounce back idea is not necessarily true. And not only that, but even if it is true, you could get to a point where you couldn't make it through with the current advisor construct.
Hey there, it's Mike Langford. Welcome to another episode of the Modern Financial Advisor Podcast. On this episode of the show, Felipe Toews, CEO of Toews Asset Management and the author of the newly released book, The Behavioral Portfolio, Managing Portfolios and Investor Behavior in a Complex Economy, is with me for a fascinating conversation about the complexities of behavioral finance, the challenges of market timing, and the importance of effective communication between advisors and their clients. We've all heard that an informed and engaged client is the best type of client, but one thing that Felipe mentions in this conversation is that most advisors are painting an overly rosy picture for their clients, and in the process, they're doing them a potentially dangerous disservice. I really think this episode has the potential to have a big impact on how you communicate with your clients. It's absolutely great stuff. Now, before we get to the conversation with Felipe, please do make sure you take a moment to subscribe to the Modern Financial Advisor podcast on Apple Podcasts, Spotify, Google Play, Amazon, the YouTubes, or wherever you like to get your podcast jam on. And if you have a question or a suggestion for a topic or a guest, hit me up. I'm basically at Mike Langford everywhere on the internet, or you can shoot us an email, podcast@finservmarketing.com. Okay, let's get to the conversation with Felipe Toews. Well, Felipe Toews, so wonderful to see you. Welcome to the Modern Financial Advisor podcast.
Awesome to be here, Mike.
It is fantastic. The old joke my dad used to say, it's better than the alternative, like not being here, right? So we're feeling good. You know what I mean? Like, I'm feeling good. I'm here. I was telling you before we clicked the record button, like that I'm personally riding a little on cloud nine here because my son is home from college for a week. So it's kind of nice having both kids home at the same time. So that I'm feeling great. Plus we had pizza yesterday. I mean, who doesn't like going out for pizza? Yeah.
Well, and spring is coming. Spring is coming. Although when you're discussing the political climate and sort of prospect of things, tariffs and things like that, I came up with the phrase "winter is coming." So, or potentially winter is coming.
Yeah, it's a great point. Yeah, a little proviso, as they say, a little disclaimer at the beginning. We have no idea what is about to happen. So we don't know. It could be awesome. It might not be. It could be a little more of the same. Who knows? But so we're just going to roll with what we know. All the information we know as of this recording. Here's what we're rocking and rolling with. Nice. So I got to tell you, I'm super stoked to have you on the show. I always love having authors. And I know that's not all you do, right? So you are the CEO of Toews Asset Management as well. But you recently just released a book, The Behavioral Portfolio, Managing Portfolios and Investor Behavior in a Complex Economy. And sure enough, we are in a complex economy right now.
Complicated.
Yeah, it's complicated. And I'm going to let you cook on that type of stuff. One other thing I want to do just to kick us off, because I'm not 100% sure if everybody in the audience is really boned up on behavioral finance. And so when I have somebody like yourself on, I'm like, maybe we can get a little primer, right, on behavioral finance 101 from your lens, right? Because I think most advisors, frankly, they're familiar with behavioral finance. They've heard about it. They've been at conferences, and that's been talked about. They follow the news. But they probably are still managing client engagements and client portfolios the same way they've done for 20 years, I'm sure, right? Like, so I don't know, hit us. What is your kind of like things we need to know about behavioral finance 101?
Well, so I loved your summary of what it kind of is, and I'll talk about that, and then we can talk about what it could be.
Yeah.
Right. Because so, I speak at conferences. I travel not a lot, fortunately, but I'm at advisor conferences, and so kind of what it is edutainment.
Okay.
Like you go to a conference, a guy who's articulate and smart, that probably has written a book or two, gets up and talks about how bad we are at making decisions and how ill-equipped, sort of like, if you take, all the DNA infrastructure and put it against making investment decisions, it's just like, it's not fitting.
Right.
And, our realization early on, this is over a decade ago, was that there's not that much out there about what to do about it. I mean, the implications of it are pretty huge, because if you're trying to make decisions, you're ill-equipped, based on how we're wired to make decisions, then that's how do you solve that? And so I think that, that's where I think we could go today, and I probably will go today. I'm assuming is that, what could it be? I mean, what if you could come up with strategies for tackling part of that, and actually maybe not making terrible decisions at the worst possible timing. Right.
That's great. No, I mean, that's a great way of saying it, right? I like that you feel like we are as a species terrible at making decisions, in part because hundreds of thousands of years, if not millions of years of evolution, we were evolving to avoid death, right? To seek food and to procreate. I always jokingly say, there's really two ways you could, motivate somebody to buy your product or be excited about it. It's people are motivated to avoid death and to get with the other person. You know what I mean? Like, let's call it that, right? If we're gonna be PG-13 here.
The simplicity of that is great. Yes.
But it's really true. Like that's your binary, and then in between there's some other stuff. But for the most part, so buying the flashy car you can't afford is you out there looking to get with the other person, right? That's you. Like, even though you look at your income, right? How much money you have, not a good decision, right? But part of your brain, lizard brain, is going, awesome decision. The ladies are going to love this. My dudes, my buddies are going to think this is amazing, right?
So you think flashy cars work?
I don't know. I guess in some segments they must, right?
Okay.
Well, I do like flashy cars. I don't have a flashy car. I do like, who doesn't like them, right? But yeah, like if I decide, you don't see a Ferrari, even though my favorite F1 driver moved from Mercedes to Ferrari, you don't see a Ferrari in my garage. Still rocking the Mercedes, just.
It's a good podcast. I feel optimistic.
There you go. I like that. I like your attitude. So let's dive into it. We can go in a whole bunch of different directions here. But let's kind of back up a little bit for you specifically. Mm-hmm. What was your, because I suspect, and you can correct me if I'm wrong, I suspect when you were in college, you weren't studying behavioral finance. You weren't doing that in grad school, but at some point in your career, something shaped your outlook where you're like, you know what? I think I need to rethink some things. What we're doing in an industry isn't the right way to go about things. What's shaped you in this space?
In a way, I was almost forced into behavioral finance. Okay. So our company that's been around forever, effectively, it was founded in 94. People listening to this podcast, some of them may not have been born then, presumably. Right.
A few of them, please, yes.
So we've always had this. Our core strategies are all designed to try to provide access to financial assets, core financial assets like stocks and bonds,
right?
But try to create a way or strategies for not participating in significant falls. And many of our strategies, we believe, have done that relatively well. If you look at the internet bubble burst, financial crisis. But what we discovered was that the timing, when we market only to the advisor community, right? So we're not talking about retail investors here. We're talking about advisor-guided assets. What we discovered was that the timing of entry and exit into our strategies was just almost as bad as it possibly could be. So the way that would look is, we started the company in mid-90s, Mike, right? So then that was the internet bubble. That was actually okay because we were brand new. We didn't have a lot of assets to leave at that point. So that's a great period in a career when it's all good news. But then we did reasonably well at avoiding losses during the internet bubble burst, but we had a lot of interest in our strategies after the internet bubble burst because now we avoided losses. It's like, wow, let's go find out what that is and explore those strategies. Then we started to have really big investor retention issues during like around 2005, 6, 7, where our strategies that can often trail during rising markets. We're not doing as well as the markets. And so we saw money starting to pour out in 06, 07. And an interesting factoid, I believe, is that the maximum departure of our strategies relative to AUM happened in the first quarter of 2008. Okay. Right. So right in the teeth of the decline, we saw money coming out. And that was all because we trailed during a couple of prior years. And then in 2008, like our strategies just nailed it. Like we were more or less kind of flat while the markets were getting destroyed, and did okay in 2009 with up capture. And then guess what? You can imagine everything wants to pour in. So, at a certain point, around 2011, my colleague Evan Burr and I, we were looking at the situation. We said, like, either we try to create a process for people to start buying these things and selling them at the right time, or we're just going to go through the thing over and over again. So it doesn't really matter if we do great with our strategies if no one's there to experience it, and they're all just buying into our strategies after big moves down when there's not much loss to prevent. What's the point? We could make a lot of money maybe, but it wouldn't really help the investors that came to us. So that's when we started exploring behavioral finance, and where we came to the realization, like, that we could read all the literature out there, but like there really wasn't that much out there that there was good strategies for addressing client communication.
Yeah, it's interesting. It's it's so funny. I love that you use a 2008, because I actually experienced the same thing. So with a client, back then I was an advisor, managing clients, and I had a client who got so freaked out. No matter what I told him and showed him, like, hey, historically during the, whether it's a Great Depression, just go down and look at all other big drops in market history. Usually within 2 years, you're back up to break even, right? Just historically, you actually come back to break even relatively quickly, because it's a shock event, right? People panic and freak out and all that type of stuff. And then life starts to normalize a little bit. He went to cash. He just couldn't handle it. I'm like, well, when are you going to buy back in? No matter how many times and this is getting at behavioral finance. This is how people behave. Okay, this hurts. Ow, ow, ow. I want to pull all my stuff out. Great. Okay. I can relax. I know I've got my money, but then all of a sudden things start looking awesome again. Well, when do I jump back in? Do you wait until it gets back up to where you sold? Do you wait till it starts to look positive? Like, okay, the trade. Well, there's a study, Dalbar, right? Dalbar does like a study on investor behaviors, and they show that the average investor who manages his or her own money, like, underperforms professional management by something like 700 basis points on an annualized basis. And the reason is that, right? You get excited,
right?
Everybody's hot on crypto, everybody's hot on internet stocks, whatever the thing is, I'm in, let's go. But then the market starts going down. You don't know when to pull out. You only pull out when it's just awful.
Yep. Like, that's exactly it. And I will make this statement, when you talk about the edutainment of behavioral finance, is that I don't think that we're a lot better as an advisory community at preventing some of these bad decisions than we were back in 2008 in the financial crisis. And so that's sort of the imperative behind what can we do and how can we get the information out there? And, there's a lot of what we do right now.
So that is an interesting question. So let's start diving into that. So what is a thing that we should be doing that we don't do, right? So I'm thinking about that scenario, right? The client who's just like, I couldn't help it. Right? So, I was trying to communicate with him. So I was telling him, this is not a good time to go to cash. Like, it's down now. Like, you're selling at a loss. Right. And then when do you get back in? You don't, like, your plan for retirement and all the other things you want to do calls for you having more growth than cash will give you. So what's at the crux here of this communications challenge as you see it? What do you do?
Okay. So there's a chapter in the book that it's one of my favorite chapters. And maybe that's because it wasn't written by me.
Oh.
It was written by, I wrote the whole book. Some people approach me and say, did you really write it?
Yeah.
I'm like, yes, I did. Except there's one chapter written by, so we have Toews Asset Management, which is our asset management firm, and we have the Behavioral Investing Institute, which is the department of the firm. And as a part of that Behavioral Investing Institute, our communications coach is Blake Short. He wrote this chapter. And I love the way he framed it in this chapter, because what he talks about is, let's think about driving, so driving is one of the most dangerous things we do, right? But we feel comfortable doing it. We get in our car, we turn on music. It's a very chill moment. We're not panicked, most of us. But maybe we should be. But imagine if you got into a car, and instead of having lanes on the highway and stop signs and clear guidance as to which lane you drive in, which side of the street you drive in, and no speed limits, and all just basically total chaos. Some people would drive on the left side, some would drive on the right side.
Yeah.
Some people go through the intersection, some people stop. And you get in this car, and now your coach, your teacher says like, okay, go. And you're just like, it would be a panic situation. I mean, you would basically freeze. A lot of people just get out of the car and say like, not for me.
Yeah, right. I'll stick to walking. Yeah.
And so he came up with that wonderful analogy to talk about kind of how investing is.
Yeah.
So investors, they don't really know a lot about market history. They don't know. We did a bunch of surveys 3 years in a row, and we asked investors, about historical events and if they knew about them. And generally they don't. Only about a quarter of investors really know how bad markets can get and market history. And then they don't know how their portfolios are designed to address significant losses or negative events. And they don't know what the plan of action is. So really what one of the things that you can think of here is that the first thing I would say that's really an imperative, Mike, is that you've got to think everything has to be proactive.
Yeah.
Right. We start now and we build a communications construct, and you really want to go from, if you think of what I just said, which is like, you don't know any of this stuff, you want to go to all the way to the other end of the continuum, which is that you want to have investors really understand how bad things can get. You don't want to, there's a tendency to maybe not fully divulge how bad things can get. It's like, oh, investor, please come invest with me and put your money in stocks, which can move down as much as 86% over 3 years.
Yeah.
Like, wow. So no, you actually want to communicate how bad it can get. Talk about specific events. Talk about what you've done in portfolios to address those things explicitly. Not diversification. Nope.
Yeah.
And then talk about what the exact plan of action is, and then get pre-commitments and then repeat it over and over again. So now you've effectively created the rules of the road. You've created an infrastructure that they can understand. That's the basic framework. And so then when these things happen, oh, okay.
I love this. So the way you described it in the car analogy, the driving analogy with the rules, but because we don't train one of the things you hear repeatedly in this industry is, hey, an informed client is a better client. They're engaged. Yeah. They want. Yeah. I think sometimes advisors are a little afraid, to your point, to give them too much information for fear they might panic, right? Or for fear they might, I'm sure it's somewhere in the back of the brain that like, oh, they might just try to DIY it, right? I just gave them too much. I showed them the formula. I don't think that happens too often. But going back to your car analogy, though, you think about everything you learn. If you did driver's ed, right? If you took a legitimate driver's ed class, think about the things you learned, right? So first of all, you learned like what to do if your car starts hydroplaning or is in a skid. This is a dangerous situation. My car is now left contract with the ground. I'm in it. I could kill myself or somebody else. What do I do? First thing you do, let your foot off the gas. Stop, hammer down. Don't hit the brake because that could make the skid worse. Let the car kind of start to slow down on its own, grab some, turn into the skid. Don't don't jerk your car. These things we've learned what to do when bad things happen. Mm-hmm. Or the whole, simple thing. If you're coming to a stoplight, you should always take a peek at your rearview mirror. because somebody else might not be stopping and coming at you, and you have the ability to kind of move out of the way. All that type of like these little things we teach 16-year-olds, right?
Right. Versus like in the hydroplaning example, versus not knowing that you can hydroplane. Right.
Yeah. Right. so
right?
The fact that you mentioned that, that stocks can go down so substantially that people don't really know that. And then, by the way, they also don't know that they usually recover relatively shortly. I was fortunate enough that I studied with Zvi Bodhi at Boston University, Dr. Zvi Bodhi is the dude who wrote the book Investments that you use in graduate school, like at any place in America, if you are Harvard, wherever, BU, you're using his book on investments. And he used to talk about, listen, the long term is just a series of short terms. Anything that can happen in the short term can happen in the long term, right? So be mindful of these things, right? Like, so the markets can go down year after year, right? They can go up for 20, 30 years in a row, but then they can also stay flat for a decade. Mm-hmm. Right? They have. So I love it. So let's just say that you're the advisor and you're like, okay, I got to start getting more behavioral communication in with my clients. Do you start with like, here are the things that could go wrong? Is that the first?
Yeah, so you do, but I kind of want to start back into the portfolio itself.
Okay, yeah, let's do it.
Is that okay? Can we go there?
Yeah, please.
All right. So, and that is, I think, look, I'm really hopeful that when and I've gotten really good feedback so far from people when they've read the book, but and the clear win is the proactive behavioral communications, but the front half of the book, I believe, could be transformative as well, and transformative in the sense of thinking first. And this has been, in my opinion, the biggest missing part of behavioral finance in our industry from the get-go, is that one needs to think first about the portfolio and ask the question, is this portfolio really designed so that I'm going to be able to coach people through it? So part of this, in my opinion, Mike, is that as advisors, we ourselves need to make sure we have a full grasp of history. And part of that means looking at true worst case scenarios. I'll give you an example of something that creates a perception of, or an illusion of, stock market invincibility. And that's that factoid that if you, going from 1926 forward, there's no 20-year period on a total return basis where you would have lost money on the S&P 500. Right. And so an advisor hears that, and it supports this idea that no matter what, as long as you just don't sell at the bottom, you're always going to come out a winner.
Yeah.
Okay. So the problem with that is that if you then actually look historically at different experiences with stocks and bonds, both individually and then together as a balanced portfolio, you find examples of times where it is completely unnavigable. So I do a worst case visualization of the Great Depression, the balanced portfolio, and I do rebalances every year. I just put the average advisor fee in there. I do with withdrawals and without withdrawals. And even if you're not taking withdrawals in the first just under 3 years of that Great Depression, a balanced portfolio would have lost 68%. So here you are, you're an investment advisor, your clients now have 32% of the original portfolio. If you're taking distributions out, 72, you have lost 72%, maybe 28% of your portfolio. There's a 5-year bull market, but the first part was fits and starts, unsatisfying behaviorally. And then there was a nice, robust bull market to finish that up. But then another 5-year bear market. And at the end of that period, you'd be down again about 65% from your starting place 13 years later. 13 years, wow. And you'd still be drawing out your fee. If you were distributing, the client would run completely out of money. A couple of things there, if you're rebalancing during that first period, you're actually increasing the max drawdown. So every year, stocks are losing a ton, bonds are doing okay, and you're saying to your client, because we're so disciplined, we're going to rebalance into stocks. And then stocks would lose another 43%. And then you do it again, and then stocks would lose another 43%. It's your clients will want to kill you. But I think it's really important to get into the weeds of this, Mike, and say, is that at all navigable? And I believe, and there's some other examples, we had a 36-year bear market in bonds between 45 and 81. It's a good example. And then if you go out to places like Japan, from 1990, beginning of 1990 to the bottom of their bear market, over 28 years, their total return Nikkei lost 72%.
Wow.
Right. So that example of 20 years doesn't fit. So that's why I say, thinking about it from the perspective of a complex economy, because we have this perception, and I believe it's an incorrect perception, that it's a bounded economy, sort of like a swing that's on a chain and it can't ever go below a certain level. And in fact, the economies are more like natural systems. And in natural systems, things are unbounded. Things can go to extremes. So one needs to bring the perspective that, if things go very badly for a country or for an economy, it's possible that this bounce back idea is not necessarily true. And not only that, but even if it is true, you could get to a point where you couldn't make it through with the current advisor construct.
It's interesting you mentioned it. So you basically I like that right at the end there, you poked a hole in the notion of hey, if you historically look back, it typically bounces back, you're back to level, and you're like, well, and you actually just fed into my Zvi Bodhi stuff, hey, it can happen in the short term, it can happen in the long term, meaning it might not bounce back within a couple of years. It actually might take 20 years, right? If you systemically break markets, break the economy, as we're all hoping doesn't happen here in the early part of 2025.
Totally, Mike. And I don't want to turn this into a doom and gloom fest.
Yeah.
But I mean, coming where we are now, which is just recently at record price to book on the S&P.
Yeah.
This is not the internet bubble. If you look at the earnings of S&P companies relative to where they were back in 1999, but record price to book, inflation is still high, and globally, debt is at record levels. And so we're at this 100% of GDP in the US and many other developed countries. Mike, in the play out from the last time we were 100% of debt to GDP, that effectively was the beginning of that 36-year bond bear market that I talked about. But how did we get out of debt last time? Well, GDP grew at 8% annual for 20 years from the time from that peak debt level. And we had 90% plus top marginal tax rates during a lot of that period. So, and high inflation and super high inflation coming out of that. So we had all of these things that helped debt to GDP recover. I don't think anyone thinks we're going to grow at 8% GDP growth, and the demographic is unfavorable. So one of my heroes is Robert Schiller, who wrote Irrational Exuberance. And one of the things I just thought was so amazing was the timing of his book, Irrational Exuberance, which he put out in 1999. And I'm just, wow, well done.
Yeah.
Because he was talking about bubbles and talking about everything right at the height of the internet bubble verse. And I'm just hopeful that this message is resonant, because I think we're not doing it from a point where we're lacking vulnerability. I feel like maybe we're at max vulnerability right now in terms of how portfolio construct.
It is really interesting. You bring up sometimes, the timing, right? Timing and severity of a risk can be really, challenging here. So what do we do to build in structurally? So you kind of hinted at it, I think. We'll go way back to the car analogy thing. In the cars, especially modern cars, there's some built-in stuff to help inattentive drivers, inexperienced drivers. Like my wife's car buzzes and vibrates if you start to switch lanes without putting a blinker on. My car has lights up on the mirrors and everything. If a car is next to you in your blind spot, and it'll beep at you if you try to do anything like that. In a behavioral portfolio, are you building in some safeguards there that kind of nudge the investor, or in this case, kind of you distribute through advisors, or nudge the advisor to not do stupid stuff?
So I have thought many times, Mike, of exactly what you were saying, which is that think about investment portfolios more from a product design perspective. And you've got this problem of people smashing into each other and having, predictably very bad outcomes. And so you have cars that stop automatically, right? If they get too close to something, or there's these lane sensors. And we need to, I refer in the book to the current portfolio construction as basically historical accident. Bonds were created to fund governments and later companies. Stocks were a way to share ownership. At some point, someone said, let's combine these two things because maybe that'll make sense. And then Jack Bogle got on the marketing campaign and said like 60-40, and everyone just like, now Vulcan mind melt, that's all we think of. But we need to think of it more from a perspective of, okay, so if the market can do these devastating things, but we know that the market is our engine of growth and that it's been a reliable producer of above inflation returns, how do we address that? And so, you say like, well, we want to start with the same construct of getting exposure to the market. We don't want to run away from the markets, but we want to build in, which I refer to as a behavioral portfolio, ways to address contingencies of risks from big deflation, which means stock market falling, inflation, or stagflation. And that's your starting place. And so once you've done that, that's a huge, we've got materials that go along with the book that allow you to then identify yourself as like, well, I'm looking at your portfolio here and I see that looks good, but have you thought about the possibility of significant stock market downtrend? Because all of this is just market correlated. Yeah. And let's build in a segment for that. Yes.
That's really smart. This is a funny question that popped in my head as I was prepping for this show. And you might think it's ridiculous, but I don't know. Is there something in the water right now? And I say this because you are not the first person who's vocally critical right now of like the 60-40 portfolio, of the way we've been managing assets. And I'm sure we've had this in the past, but I think right now I've been hearing it from a lot of people. And in fact, I just recently had Saira Rahman from Fundrise on, and then Steve Vecchione and Scott Schubel from Satera Advisors on. Like these people are just saying, hey, listen, the way we've been doing things, and if you want to check out those other episodes, go check them out. The way we've been doing things isn't necessarily the best but also they seem to both have come to the realization that the world is changing, right? So as you were describing what happened during the Great Depression, for example, I'm like, the world isn't the same as it was back then. Yes, we were a global market. We've always been a global market since we invented sailing ships, right? But data is faster now, instant, right? The average person invests now, right? The average person really wasn't investing in the 20s and 30s. You know what I'm saying? Like the average American didn't have a 401k where automatic payroll deduction is continuously going into an account all the time, right? We didn't have all these new DeFi options, right? Where we're starting to get off of some traditional markets, and blockchain is starting to run things. Like we didn't have anywhere near the scale of private markets and access to private capital to the point where the actual number of public companies is starting to shrink as a proportion. So you get what I'm saying? Like, is this something in the water? Is it because of today that you're smart people like yourself are coming up with these notions?
I wonder if 2022 didn't have some influence over it, because we got to see pretty clearly how there was this correlation between stocks and bonds. And so where bonds for 40 years prior to that had acted as this great stabilizer. Yeah. And they would bolster returns when stocks fell. I wonder if that isn't part of it. But I also do think that just the recognition of debt levels from a government perspective, and also the changing demographic of population shrinking rather than growing, play some role. But I welcome it. And I just think that if part of what's afflicting us, in my opinion, is the Chicago University Nobel laureate crew of like super smarty pants that did valid studies, but we're conflating something. The Gene Fama with the efficient markets. This is one of the most interesting conversations I always want to have. Is that Gene Fama is shown with an obscene amount of data that markets are relatively efficient, and that you can either, if you're trying to maximize performance, you just leave everything alone.
Yeah.
Right. And so it's hard to go. And so that then guides everyone. But the point is that we're not trying to maximize performance. What we're trying to do is build effectively a product, something that, just like we're not getting in an F1 car with our clients, we're trying to build something that makes sense, that addresses both short-term and long-term, and also addresses peace of mind, addresses psychological needs and things like that. So ultimately, I think that's going to win, but I think it might take some turbulence to get there.
Yeah. I love the fact that you do the peace of mind, because I always say, you think about why is somebody hiring an advisor, right?
Yeah.
It's a sleep at night factor, right? They feel comfortable with you, so you're going to feel comfortable and confident in their financial future. That's why they've chosen to work with somebody and not do the DIY approach, right? Exactly. Now, some of it could just be, at the root of it, like, this is too complex for me. Well, yeah, if it's too complex for you and you're worried about the complexity, you're choosing somebody who you feel comfortable with, right? Like, the sleep at night factor matters, right? Like, nobody wants to wake up the next day and find out that they're worth half the money they were worth the day before, right? Like, nobody wants that feeling. So if you can, even though you're going to have clients who are like high risk tolerance, they want to swing for the fences, if you will, I assure you that person will not feel super good if they wake up tomorrow and it's half. What are some early states or entry level, call it, other than reading the book, of course, we want people to read the book.
Okay.
What are a couple of entry level things, if you want to call it that you would recommend that advisors do in communicating this type of thing with their client, like starting to shape, like, okay, here's what I would do. You said history. So going all the way back, or what type of things should they start introducing to their clients?
Well, so I just exploring market history. We've identified what we think are the 6 biggest investment challenges that investors confront behaviorally. And the first one we've already talked about was just significant losses, but there's some other big ones too. Like, investors really don't like just going sideways for very long periods of time. So long periods of low or no returns is certainly something. A big one that is unrelenting is, trying to get into the best performing category. I mean, just think about how everyone's really wanting to flock right now to large growth, potentially with perfectly bad timing, right? Everyone just cares about those Mag 7, and maybe not so much in the last couple of months, but they care about that. And how about this one, like not participating in asset bubbles? So part of it is say, like, hey, here, investor, here are some things that I'm tempted by, and I think you may be too. And just list these challenges and say, like, this is a thing. And then the next step is to come in and say, so here's what we're doing in the portfolio to explicitly address these things. So in the case of significant losses, in the behavioral portfolio, we say, take 50% of your equities, put it in conventional stuff, but take the other 50% of your equities and put it into hedged equities, something you can attempt to uncorrelate.
Yeah.
So then, boom, right there, you said, like, that's explicit. And this thing may even do better than it would have if the markets moved down, because it'll miss out on some of that and then participate in a rebound. And with, fixed income, be adaptive to try to reduce principal risks and inflation risks. So then you refer back to that in the portfolio, and then you talk about explicitly what we're going to be doing when the market actually makes a big move lower. And in the case of those hedged equities, you're actually rebalancing out of the stuff that did well, like hedged equities back into the market. So it's laying out that framework across each of these big challenges and creating those the lanes on the highway.
I like it. And it is funny, like, people are, and this is where an advisor really comes in, right? They don't understand, the average person doesn't understand hedging, right? Hedging against risk. Right. They're unaware that you can, buy options or, have some sort of, packaged product that's like, hey, listen, yes, it is absolutely exposed to the upside, but built in there's some stable, more safe type stuff that doesn't have as much volatility in it. Huge help. What are the other things while you were describing, like, informing clients about the things that could happen, right, and covering those things, is I wonder if you talk a little bit about potential life events that most people don't think will happen to them, but do happen to them. And some of them are insurable, right? Obviously a death or something like that. But like things like divorce, like late stage divorce, like, 50% of marriages end in divorce. My parents got divorced after being married for 50 years, right? Like weird stuff happens. Do you talk to this is the type of stuff you might want to have conversations about as it relates to behavioral finance? Or because to me, that's like, I don't know, you think about all the things that could happen. We're talking about your portfolio, but we're also like, here's some stuff in life.
So for that kind of a thing, I probably personally wouldn't want to mention like your potential impending divorce to a couple. but no, I think that your directionality is perfect. Like, because like thinking about building in conversations about what may happen and then how you do that.
Yeah.
I don't know if you've probably come across this. There's a software program called Income Labs that I actually talk about in the book that what it does is it's like, look, we're going to be watching the markets. And if we see we move down to a certain point, we're going to adjust your income levels lower. Another example of how, okay, not only are we not fearful of this kind of market decline, but we have a strategy.
Yeah.
We have a plan for if these things happen so that we can make sure that we make this and we don't run out of money. All just around thinking about like, how do we make sure that we feel comfortable that we've addressed these problems. And then when they come along, Mike, early on, we started doing behavioral finance workshops back in 2011 and talking about some of our ideas around how to manage investor behavior. And there was an advisor in the audience. Obviously, this is just 2 or 3 years post financial crisis. And he said, during the financial crisis, all of his clients kept calling in and saying, when are we going to rebounce back into and buy stocks? Right? Just making the counterintuitive decision for, where you want them to go.
Yeah.
And that's always been a bit of a beacon for me in terms of what we were really trying to accomplish, which is that you've done your job so well at preparing investors that, you talk about the Dalbar study where people are trailing the markets. Okay, what if, because advisor-directed assets also trail the markets in our studies. So what if you could not only bring people up to get market level returns, but what if you could actually increase returns as a result of some counterintuitive decision-making along the way?
Yeah.
I just think that, we started talking about edutainment, which is sort of where I believe behavioral finance has been. This translates into, even transcending peace of mind, potentially dramatically changing the overall return profile of an investor as a result of some of these efforts. I think that's where behavioral finance can go.
Yeah. I agree 100%. Again, this is all about like helping people recognize when they might be making a bad decision, right? And avoiding those. 2 that I want to get your take on.
Okay.
That are related, and I think you touched a little bit on it before, having people avoid, I don't know, some potential craziness that they're seeing. FOMO and what do they call it? Mimetic desires. Is that what it's called? So, FOMO being fear of missing out. You're seeing your friend make a crap ton of money on crypto or you name it, right? Back in the early days of the .com boom, right? Pets.com type stuff. There, you see your friends make it. The guy who sits next to you, who's just a complete dunce, is making crap tons of money. Mm-hmm. And the other one, the mimetic desire, is, if you have it, I suddenly want it. It's sort of related to FOMO, but like the fact that other people have something, like I need to have one too. Like, oh, all my friends are now getting into fancy watches. I think I need to buy a fancy watch.
Yeah.
Right. How do you tackle those types of things? Like,
well, crypto is a real challenge, Mike, because one of the things I used to say back before crypto became such a big thing, that was part of our investment owner's manual that we advocate, was that, if you're broadly diversified across a market, so, right now, if you're just in an S&P 500 cap weight fund, you have had significant exposure to the Mag 7 stocks. So to point out to investors that like, yeah, these stocks are going crazy, Nvidia is going crazy, and we own a decent chunk of it, and we have benefited from it. And so it's part of the portfolio profile. And so and then what we're going to do is we're going to occasionally rebalance out of that and basically harvest those gains.
Yeah.
And take those. And so that's been satisfying. Crypto is a challenge because it obviously there's a huge difference of opinion about this.
Sure.
In my opinion, it's effectively a non-asset. In the criteria that I lay out for building a behavioral portfolio, one of the things I say is for any core asset, it needs to be something that has a reliable history of producing either income or above inflation gains.
Yeah.
Crypto does not meet that. Crypto is more or less a non-asset that's fueled entirely by speculation. So how do you address the desire that basically the entire world has of, I wish I had done that 20 years ago and I'd be rich. And why can't I do it right now? I almost think we're to the point where I really wanted Mike to launch a Bitcoin blow-up ETF that would participate in Bitcoin, but also make money if it blew up.
Yeah.
The options are way too expensive. It's not possible, but we're almost to the point now where just having a 5% exposure, but have some participation in it, understanding that and you talk about, use the word blow up with them, might be a thing, but it's a really, it's a really powerful impulse at a certain point that investors are going to say, like, look, either you give it this to me or I'm going to buy it on my own. So,
Well, that's it. You run the risk, and I'm glad you said it the way you said it. You run the risk of your client suddenly thinking they're smarter than you because they made a speculative bet that worked, or that their buddy did it and they didn't. Because like that missing out thing is a real deal, right? So you could have done everything right as an advisor. We're like, hey, I managed your portfolio. We avoided big dips, right? We use behavioral portfolio theory and behavioral finance to do this. Like you are so on target for all your goals in life. Everything's looking great. But if you keep looking across the street and you're at your neighbor, right? And you're like, they did this thing that they feel like their advisor talked them out of, right?
Yes.
That could be a burn.
I mean, like, I guess if you like would do that and then it does go crazy and makes a lot of money, and you're harvesting out of it every quarter or something and taking those gains, maybe you could actually make a net gain.
Sure.
Even when it ultimately blows up. I think that it's really interesting to continue to think about where crypto could go, or at least cryptocurrencies.
Yeah.
In the sense that, everyone looks at the Great Depression and says, yeah, but there was no FDIC and, a bunch of banks went completely bankrupt. And when banks went bankrupt, it's just like money vaporizing, money disappearing. And what's so interesting is that when we saw it in the financial crisis with derivatives that were unregulated, these AAA derivatives that were worthless.
Yeah.
Right. So that's sort of, it transcended regulation. It transcended the FDIC. And now you've got this basically non-asset that, just recently was $4 trillion overall market cap. The total value of the stock market right now is about 50 trillion. So almost 5%. Total stock market cap. But what if it would go up to like 50 trillion in total market cap of cryptocurrencies? I mean, now you've got the possibility of money disappearing.
Yeah.
Just like we had with the banks. Right.
Yeah.
So.
Yeah. So, well, best way to protect, as you were saying, like talk to your client about these types of things. You didn't come on the show thinking you're going to be talking about crypto, but I do think it's a real question because today's investor, I actually had somebody on recently. We were talking about digital assets. We were talking less about crypto, but we were talking about digital assets, like some new infrastructure assets and so forth. And, his point is like, look, people in Gen X are like most avid investors, right? So it's not just young folks. Like you're thinking like, oh, well, it's just, these college kids and, young millennials, all that type of stuff, maybe, even though millennials are now some of them are in their 40s. But it's like, you made the point that you're starting to see a lot of heavy investing in digital assets and crypto from Gen Xers, right? So this isn't young folks anymore, just young folks. So some of your clients are starting to look at this and they might not just all be people who are like, look, they're just trying to score it rich. So it's worth having the conversation.
Mm-hmm.
Okay. So we're getting close to the end of the time. I know you didn't want to end on crypto. Talk to me a little bit about crystal ball time, right? As you look out at the current economic landscape, what specific risks do you see on the near horizon, I guess? And what might we, as a financial advisor community, be underestimating that we should be talking to with our clients?
I love the question because I think that it creates a pathway that we at least need to contemplate, but not say it's going to happen or bound to happen or necessarily even could happen. But I talked before about the situation where with sovereign debt, both in the US and most other developed countries, at the same time that we have a declining population of people that are primarily earning and saving and working. And so you have this misfit of big debt and not the probability for a lot of GDP growth to get out of that. And so what I think that creates a possibility of, it's like looking into the sun, Mike, and we really don't want to do it, but I think we should, is the possibility that we have a different kind of inflation. And it's inflation that now we're looking way back beyond just like really US experience, really other fiat currencies. And think about, so let's just say we entered some kind of a recession here. It's been a while since we've had a meaningful recession. We had a brief one during the pandemic, but enter in some kind of recession. And at a time when we need to grow GDP, pay off our debt, we have a declining GDP. And I don't think we're in any mood at this moment to do fiscal stimulus.
Yeah.
Just the opposite is happening. But what it does is it creates the possibility that we reach this point of unsustainability in debt. And that's what Ray Dalio has been talking about a lot. That hasn't been contemplated by the advisory community, because if you think about where that might go, what that looks like is a dislocation between where the Fed wants to bring rates and where rates are going. And so if you get rates going even higher at the same time that you already have a declining GDP, if you reach that point of unsustainability, that looks like very bad news for bonds, where potentially you could have, double-digit inflation that's not capacity-driven, but rather it is currency sustainability-driven. And it's not maybe just in the U.S., but other places. Yeah. And so I think we need to think unconventionally about bonds, think about adaptive approaches, but also what I reveal in the book is during the high episodes of inflation in the U.S., if you look at that 36-year bond bear market and say, what did stocks do? Stocks did actually great during that 36-year bond bear market. Why? Well, during periods of high inflation, stocks are real assets, and companies can increase assets and they can adjust for that inflation number. So part of addressing that contingency of a potential train wreck for bonds is making sure you have an adequate equity portfolio. Yeah. But part of having that adequate equity portfolio is having part of that be hedged in case we move down coming into some kind of a recession or something like that. So I don't know if that was more than you bargained for.
No,
Mike,
it's good. I like it.
Because, but who is really seriously contemplating some kind of currency issue in their portfolios? I mean, really, right? Not too many.
Yeah, so. Yeah. And it's often hard to describe. Certain things are difficult already to describe to a client. Because most of them don't even relatively understand the difference between stocks, bonds, and mutual funds, that type of thing. Yeah. But then getting into let me tell you about how currencies work and how that affects inflation and so forth. But no, I mean, one of the things I think you're smart to bring up here is there is some risk in terms of GDP growth. I mean, you touched on the concept of demographics a couple of times. Mm-hmm. A slowing growth of the population. I remember this may disprove this argument, by the way. So I met an author of a book, I had to bring it up while you were talking, called The Death of Demand by Tom Osenton. And this is back when I was in shortly after grad school. And I can't remember exactly how we got introduced, but his whole thing was listen, during the baby boom wave, right? The reason why we saw so much growth was the war generation came home. They had a bunch of kids. They had to buy a whole bunch of stuff to feed those kids, clothe those kids, all that type. So there was a super big growth. And what happens when baby boomers became adults? They had to buy houses, cars, this and that. So we just kept on growing. Yeah. His prediction was as a baby boomer generation kind of comes to an end or whatever, you're going to see the death of demand, right? Everybody who has a car, wants a car, has a car. Everybody who wants a TV has a TV, all that type of stuff. We've still seen growth since then because that book was published in 2004. But demographic dynamics have changed dramatically since then.
Yeah. Well, as you're talking, there's so much press right now about like AI agents and robots taking care of us and solve all these problems. I mean, I think I saw something recently about how Japan has a plan, and it involves robots and AI because they've got it way worse than we do in terms of how their population looks. So I mean, I think that, that helps reveal. It doesn't matter. You can discredit some of these ideas. I would love to discredit the idea of like a currency crisis in the U.S. But I think that it just highlights this notion that, and I think it should be like almost line 1 or 2 or 3 in terms of thinking about portfolio construction, is that we can't predict the markets.
Yeah.
Right. All we can do is try to position for optimism and then build in contingencies to address the possibility that these things happen. But you just can't be a doom and gloomer. You just can't be betting against the markets and saying like, oh, that sounded really depressing, I'm just going to go high. You got to stay in it.
Right.
Yeah.
I think that's a great way to end. There are things you can do to protect yourself against downside, right? While still making sure that you're participating in growth and upside. So awesome stuff. The book is The Behavioral Portfolio, Managing Portfolios and Investor Behavior in a Complex Economy. Felipe Toews, wonderful to have you on the show. Where else can people follow up along with you? You're active on LinkedIn. What do you got going on?
I am on LinkedIn, but definitely I'm just going to make the challenge. You can't, as an investment advisor, you can't read the first half of the book, I believe, and not have your views on investing fundamentally change. And so that's my challenge to every advisor on this call. And because you could go to the website and you can get everything else, but I've already been having a lot of conversations with advisors who've read the book, and even $1 billion RIAs are saying, I have to change things. So that's really my challenge to you, is get to Amazon or get your Kindle or hard copy.
Awesome.
And
have that linked up in the show notes so people can get it.
Okay.
Thank you very much for coming on the show. This is wonderful.
Awesome. Great.
Thank you very much for listening to and or watching this episode of the Modern Financial Advisor podcast. It's always fantastic to have you with us. Huge props to my man, Felipe Toews, for coming on the show, and congratulations, sir, on your new book. Really amazing stuff. I love this conversation. Now, as I mentioned at the top of the show, please do make sure you subscribe to the Modern Financial Advisor podcast on your podcast platform of choice, and swing over to the YouTube channel as well. Click that subscribe button there and give us some likes and all that type of stuff. And let me see. That's all I have for you. Last thing, be nice to each other. We'll see you next time on the Modern Financial Advisor podcast. See ya. Bye.